Good evening, and welcome to the Angry Capitalist Podcast. We're now on episode 21. Jeez, can you believe it? Let me go ahead and shut off a banner here for the 30-second thing. Just trying that out in the intro. So, for today's episode, what we're going to be covering is a topic that is near and dear to my heart out of hatred, and that's taxes. So, if you haven't already seen them, I've done 2 videos now on the topic of house hacking. And for today's video, I want to go into house hacking, how it relates to taxes, as well as some of the advantages to house hacking that come from a tax perspective. 2 points on that. 1, this video should not be taken as tax advice. There's a few technical reasons for that beyond the blah blah legal disclaimer. 1, obviously legal disclaimer, I'm not a tax professional, and I'm also not your tax professional, and I don't know your situation. So what I mean by that is some of the stuff that I'm going to cover in this may not be appropriate for you. That's where you should do your own due diligence and or talk with a tax professional in your specific country and or state who can best guide you. Additionally, there's a temporal aspect to this. So tax code and tax laws change all the time. They're constantly changing. That's where, once again, doing your own due diligence and checking with a tax professional in your area needs to come into play, because even I've had this happen where you look at a video from 5 years ago or even a year prior, and the stuff that they're discussing is out of date. So, well, it's great that we can have evergreen content and the broad principles can usually be held and transferred throughout time. Do your own due diligence. Take personal responsibility for yourself and your actions, and just please don't be a bitch. If you'd prefer that I just go ahead and slurp right into the microphone as I'm drinking tea, please feel free to drop that down in the comments down below. And for anyone who cares or is curious, I'm drinking Full Circle Market organic Earl Grey black tea. It's pretty good, nice and tasty. Good amount of caffeine to go ahead and end the day off with while I'm doing these videos. So, a few points on and what it is exactly, if you're not already familiar with this concept. So, effectively, what house hacking is where you buy a multifamily or multi-purpose building that you live in, and you rent out the other portion of the building to help offset the cost of the ownership. Now, when I say multi-purpose, that could also be applied to situations where, let's say, you have a building that is zoned for both residential as well as commercial space, and you have an office or some kind of a studio downstairs, and you have apartments upstairs. You could live in one of those upstairs apartments, use the unit downstairs, which is commercial, either renting that out to someone else, or let's say you have your own business. You could put your own business in the same building that you're living in and rent your business space to yourself. That gets a little bit more convoluted and complex, but effectively, if you're using your residence to generate income from either rent or other business purposes that you're living in, you're house hacking because you're offsetting your cost of living with those rents or the income from that business. What I'm going to be going over on the rest of the video are going to be some considerations for you to research on potentially things to check in with a CPA. I may bounce around a little bit in this video. First, I'm going to go ahead and kind of go through this, a few considerations, and just different things to think about and concepts to have in mind. And then at the end, I'll be doing a walkthrough example just with a spreadsheet that I put together really quickly. So, one of the big questions that I find with house hacking that you really need to ask yourself from a tax perspective is, do you want to take profit or a tax deductible loss? So if you're living in, let's say, a duplex, do you want to try and make a profit off of that duplex while you're living in it, or do you want to take a tax deductible loss? Likewise, this can also apply to if you have a fourplex, triplex, you have a triplex with some commercial space, so on and so forth. Now, reasons for taking profit, it's more of the situation to when that would make sense for you. But the obvious reason there, of course, is, hey, take some profit where you can, right? But why might you want to take a loss? Well, here are a few things. One, let's say you bought this property recently, and it may make sense to take a loss because you want to invest into the property and you want to make improvements and upgrades, thereby increasing the property's value. A few other situations that you may run into that I think really go into tax planning for the year. So, as an example, right, CPAs are most busy right around tax season, and that just finished here as of recording in May of 2024. So over the next couple months, as you know what your income, you have a better idea of what your income situation is going to look like for the rest of the year. For when tax season comes around in 2025, whenever you're seeing this video, it may not be a bad idea to go ahead and sit down with your CPA and do some planning for when you have to pay taxes in 2025 to help try and legally avoid paying taxes as much as possible. So here are a few considerations. These are just things to have in mind, situations that you should think about and potentially research or look into more in depth with a CPA. So outside of, of course, putting money into the property to increase its value, and hey, look, you can also use that in some situations as a write-off. It may also make sense to try and keep yourself below a certain income tax bracket. So a few examples to this could be things such as trying to lower your capital gains and your dividend tax rate. So if you can make your personal income look lower, right, through legal tax avoidance strategies, you could potentially pay a lower rate on capital gains and dividend taxes. Additionally, by making your overall income look lower through tax deductible write-offs, effectively, or deductions, that could also make it so that you could qualify for certain grants, loan programs, scholarships, and so on. Additionally, of course, there is always the idea that you may want to reduce your end-of-year tax burden. So you may have had some kind of a windfall that year, or you may just be looking ahead at a year where you're going to have to pay more taxes for one reason or another. Hey, if you're house hacking, if you're living in a duplex that you rent the other side out to, it may make sense to put some money into the duplex to reduce what you'll have to pay at the end of the year. So let's say, for example, you're looking at having to pay like $1,000 in taxes at the end of the year when you sit down with your CPA. Hey, why not put that towards the property instead? And overall, just think like when you're house hacking as an owner occupant, your overall home renovations become a tax deduction. I did this with driveway replacement. You can do this with your landscaping, new roof, new siding, anything like that, electrical upgrades, so on and so forth. These home renovations that could benefit your situation for living can suddenly be a tax deduction. Once again, for all these different scenarios that I've laid out, these may change from year to year. Likewise, you may have certain situations where it'll make more or less sense to explore these avenues. So do some research before you actually pull the trigger on anything. And once again, I highly recommend sitting down with a CPA to plan ahead for the year when it comes to this. A few examples, just for those people who kind of need that method of thinking. I know it helps me out. One sec, I'll go over those here in a second after a tea break. It's pretty damn good. So, example one, you and your CPA sit down this upcoming June, and you're looking at your projected income for the year. And you may be facing a tax bill of $5,000 at the end of 2024 going into 2025. Now, depending upon your current tax laws, it may make sense to spend enough on your real estate in investment improvements to offset the projected tax burden. So you're house hacking, you sit down with your CPA, hey, you probably have this tax bill of about $5,000 coming up. Let's go ahead and put $5,000 plus dollars into improvements in the property to use that as a write-off. So that way you don't have to pay extra in at the end of the year. Now, example two, you sold stock this year and you made a massive profit on it, or some kind of other asset, you sold it, right? And it does, which does qualify as a long-term capital gain. However, at your income level, that means you'll owe 15%. I checked the capital gains rates here as of May 2024. Keep in mind these numbers may change over time. However, you will owe 15% in long-term capital gains taxes. Now, that's based off of your personal income. You are projected to have income $13,000 over the tax bracket, which separates you between 15% and 0% in long-term capital gains. It may make sense to put $14,000 into renovations and improvement on the real estate that you're occupying to get below that 15% tax bracket and to get the 0% on the capital gains that you've sold so far. All right. Now, before I go over to the spreadsheet example, I have a few recommendations. A lot of these are based off of my personal experience, things that I had thought about a little bit more in advance when it came to house hacking. So number one, pretty obvious. Luckily, I didn't mess this up. Track all your income, including the income from your real estate. Some people will attempt to artificially make this income look lower. Let's say your tenant pays you in cash. It may be tempting to not report at all. One, you don't want to get caught with your pants down. Second, actually, this is a pretty good reason that I find favorable. Even if you make your overall income at the end of the year look lower through improvements, by reporting all of your income from real estate, that can qualify you for higher loan amounts down the road, which can help you out if you want to get another real estate asset or some other kind of asset that you want to use a loan for. Next, track all of your expenses. Save a digital copy of receipts and invoices. This is something where in my first year owning this place, I had a good number of receipts that were just in paper. I didn't have a digital copy, and I ended up losing a few of those. Not the biggest deal in the world, but it was still something when I was going through getting ready to prepare my taxes. It just kind of, I kicked myself in the ass real good on that. Like, hey, dude, had you set this up so you got emailed every time you went to this vendor for stuff that I would buy, Lowe's as an example. After this point in time, I had set it up so that every time I go to Lowe's, I get an email copy of my receipt. I didn't have that set up at this point in time, and I lost the physical copies. Likewise, I'd gotten an app on my phone so that I can just scan a picture of my receipt, and then I have that digital copy, even if it's at a vendor where I can't get that email to me directly. So save a digital copy of all receipts and invoices, just so it's harder to lose. And it's also easier because then you can attach those right when you go to file for taxes or send it over to your CPA. It'll just make stuff go so much smoother. Now, at year's end, you may have to issue a W-9 for certain independent contractors. These can be things such as your accountants, lawyers, electricians, plumbers, etc. So make sure you save their information. As of recording, I believe the limit amount is approximately $600. So let's say you had to pay an electrician, right? And if you had to spend more than $600 on the electrician, you may have to issue a W-9 to them. And you would have to report that W-9 when you go to file your taxes. So keep a hold of their contact information so you can set that up. Next, meet with your CPA at least once or twice a year to plan your financial strategy and prepare for possible tax consequences. And what you're going to do with this is you're going to make what's called a pro forma, or make some projections. Effectively, you want to project your income from all streams for the upcoming year, and your CPA, or you can do this yourself if you want to, you can sit down and look and see like, hey, what are my tax consequences at the end of the year? Look ahead, plan, and adjust accordingly. That goes back to our examples where by sitting down, by looking at your tax situation, you may know like, hey, I'm going to have a bill at the end of the year if something doesn't change. Let's put some money into improvements on this real estate that I'm occupying. Let's see. Next up, meet with or just email your CPA if any big changes as they happen. This can be an increase in regular income if you sell off any assets at like a high dollar amount. If you buy any real estate, you get married, have kids, etc. Communicate that over to your CPA so they know in advance, and they can let you know ahead of time if there's anything that you need to watch out for when it comes to taxes. Now, if investing into upgrades and improvements for tax reasons, it may also be a good idea to verify in advance with a CPA as to what exactly qualifies for a deduction. This goes back to the idea that the tax law and tax code changes periodically. So before you go to put any money into certain upgrades or improvements on your property that you're house hacking, either at an earlier meeting in the year, or if you haven't had that kind of a sit down yet, verify that those expenses, those upgrades, improvements, etc., whatever it is, that it'll actually qualify as a deduction. You don't want to go ahead and put money towards your asset thinking that it's going to be a write-off, and then when the time comes to go ahead and start filing and putting your paperwork together, hey, guess what? That doesn't actually count for whatever stupid reason. So I'll go ahead and share my screen. I'll do a quick tea break and pause the video while I do that, and then we'll go over to the spreadsheet. So one sec. All right, and here we go. So for anyone who hasn't seen the previous house hacking videos, I have this spreadsheet that I put together just to give you an example of looking at some numbers and to try and visualize the exact mechanics. So this is just a dummy example that I threw together. None of these numbers actually reflect anything in reality, and a lot of them are just pulled from approximations. So effectively what we're looking at with this is a really, really simplified example of how taxes work. So at the top here in cell 4B, we have annual income from rents. So here we have from the property in question, we're looking at $14,500 $400. The example that I'm going off of with this is that you're a owner who is occupying a duplex, and you have to put, I believe it was $846 or $800 towards the cost of the mortgage per month. So your real rent that you have to contribute is about $800-900, and that you're renting out the other unit for $1,200, if I remember correctly. And this is the rents from your tenant. This is your income that you're collecting and that you report via taxes. Now down here we have, these are called CapEx contributions. This is effectively additional money that you'd want to put aside, just with the idea of trying to put money off to the side so that when you have some kind of a big repair or some kind of a bill, something breaks that you have to have fixed or replaced, this is what you want to put away throughout the year to help offset that cost. But that's not super important for this example. So in situations where you're putting money for real estate aside in a separate account, not a deduction, just something that we're going to try and visualize. And I'll go back to that here in a little bit. Next up, non-deductible expenses. So this goes back to the idea that certain expenses with owning real estate will not actually count for tax purposes. So as an example, when you get a mortgage, as of time of recording, your principal that you pay each month for your mortgage, the principal amount is not tax deductible. However, the interest, insurance, property taxes, and depreciation, those are all tax deductible as of time of recording. So the interest amount that you have to pay throughout the year on your note, as well as your insurance, property taxes, those can all be deducted and used as a form of write-off to reduce your income, your taxable income. Now, when it comes to those three examples in particular, you should be getting a 1099 from your lender, from your mortgage holder, at the end of the year and going into the next year. Usually you'll receive these around like January from your lender. That 1099 should have your amount for your property taxes, insurance, interest, etc. Now here we also have depreciation. This is something that'll be more calculated by a tax professional in terms of what you can write off for your asset. So something to keep in mind with real estate, if my memory serves me correctly, the piece of land, that from a tax perspective holds value and that does not depreciate. But the actual structure, the structure itself, because it takes maintenance to keep it up and because it will over time slowly break down, certain systems will become out of date, that structure is depreciable. So that's where you need a tax professional to come in and assist you with figuring out your depreciation year over year. If you're using something like TurboTax, they do have a function to help calculate that for you, but it's a good thing, once again, to sit down with an actual CPA in person, get that number in advance before you go to file. Now, next we have the maintenance / owner's expense, and we also have planned improvements. So, apologies. Those are highlighted here in turquoise because the maintenance / owner expenses, that should be somewhat planned. Keyword somewhat planned by you, the owner. That's going to be like your month-to-month maintenance. Let's say you get pest control done regularly. Let's say you have to pay to have the grass cut or the driveway snow blowed or something like that. Predictable expenses like that would be your maintenance, and that would also include your repairs, owner's expenses. If you have to pay to have door handles fixed, plumbing work done, so on and so forth. That may not be completely planned so far in advance, but the maintenance and owner's expense, that should be somewhat planned. Now, we also have planned improvements. So these are upgrades to the property and to the asset, and these should be planned well in advance, preferably. So we have down here below, we have total expenses and we have tax deductible expenses. So what we're doing here is effectively separating. We've got all of these depreciable expenses, and then up here we have the principal, which is not tax deductible. Once again, what exactly can and cannot be deducted may change year over year, and it may also vary depending on the area that you live in. So this is where you want to sit down with a CPA, figure out, or do your own research on this if you want, and just figure out, hey, what is a deduction, what is not a deduction. Know that well in advance so you can plan accordingly, and you can put a spreadsheet together, something like this, just so you know what you're looking at. So once again, total expenses, all expenses that you face and incur. Then we have the expenses which are actually tax deductible. Now down here we have total profit / loss, and then we also have taxable profit or loss. So in both situations we took a loss. So total for the year we lost $11,900. Most of that was in the principal amount. It is what it is, but we did have quite a bit, which was an actual tax deductible loss. Now, what I'm referring to here when it comes to the taxable profit or loss is, once again, if we look at the annual total income of $14,400, we're not going to have to pay taxes on that full amount, right? But we can't exactly use all of this as a write-off. So in total, we lost $11,900. However, we took a loss of $1,100, a little over $1,000, effectively. That was a taxable write-off. So the way to think about this bottom number, right, is it adds in to your other taxable income, your regular taxable income, let's say, right? So if you have a salary of, I don't know, $60,000, right? You have a taxable amount of that salary. So various deductions go through, you reduce it down to a certain proportion, you're left with a tax bill, and then you can also use this as another write-off to reduce your tax bill down even further. So this goes back to the idea of, let's say for whatever reason it is, you're looking at owing the government at the end of the year about $1,000. So, provided you have enough time and you verify that this would be an appropriate deduction, let's say you want to go ahead and put $6,000 into planned improvements, upgrades to the property. Boom, we've now taken a $2,000 loss on this property that you own or occupy. You can now effectively cancel out what you were about to owe the state. So if you're about to owe the state $1,000, when you're planning this kind of thing, maybe you spend a little bit more on some planned improvements, or maybe a little bit more on maintenance, different amenities, etc. You can then go ahead and use that as a write-off to wipe out your tax obligation or to just reduce it. Let's say, once again, that we're looking at being in a tax bracket that, when combined with various other factors, is just not advantageous. Hey, you know what? If I put a little bit more into improvements, boom, let's say I'm going to put a new roof on the place, or have some other kind of major renovation done, I can now take a greater loss, which, depending on your tax bracket, could get you down to a lower rate, which for whatever reason may be more advantageous for you in your given situation. Reduce that back down to 5K. Once again, the big takeaway here is that we're looking at this bottom number after we've done all these other calculations, so on and so forth. We're looking at this bottom number. It's either going to be a taxable profit which let's say you made $1,000 that year, right? That $1,000 is going to go on top of your regular or earned income. That will be taxable, and it's one of the most taxed, or actually, I believe it is earned income, meaning what you get paid on your W-2, or if you're self-employed, your 1099. That is the most heavily taxed thing, at least in the U.S. So, let's say that $1,000 was going to be tacked on there at the end of the year in terms of profit. Hey, great, you made $1,000, especially as house hacking, but there's a tax consequence for that. You're going to have to pay on that $1,000. And it may also just put you slightly above, up into the next bracket, which for one reason or another may not make sense for you. It may be disadvantageous to go up a bracket for whatever reason. So once again, doing some pre-planning when it comes to taxes and house hacking can save you a ton of money. Go ahead and stop sharing. Come back over here. There we go. All right, cool. So I hope you like this kind of content. If you have anything that you believe was not explained very clearly or that doesn't quite make sense, feel free to go ahead and drop that down in the comments below. Likewise, if you're looking at house hacking, or if you are house hacking, how has that been going? Please share your comments or experiences down below. Likewise, if you enjoy this kind of content, please make sure that you hit the like button. It lets me know that you enjoy this kind of content, that you want to see more of it. Likewise, if you do want to see more content that I'll be putting out, make sure you've rang the bell and that you've selected your appropriate icon. Whether you select all to see every video that I upload, or personalized to have stuff that'll be more curated for you and your taste. Well, with that, if you have any other questions, drop them down below. Thank you, and have a good evening. Take care.